Mic test. Live, yay! It's a Friday for me. Um, yes, just got off work. Um, a lot happened, but it's okay. Right, so today we're going through, question 3. Left off from the previous lesson, right? Um, my student is unfortunately not available today. Due to certain reasons, but it's okay. Right. We'll just roll with this and trying to change up something. Maybe I will state what this question is looking for, like what the examiner is looking for, and then go from there. Right. Um as usual, my theory isn't the strongest when it comes to perfect answers because my memory is quite bad. Yeah, and for those of you who are watching the VOD back and if you're new here, let me just give a quick introduction since we have some time, right? Um, First of all, welcome to the channel. Thank you for clicking on the video in the first place, right? What I usually do here, well, the usual content happening twice a week is teaching accounting, right? Mainly beginner level. Um, the goal is to actually help people who are, um, you know, either in the field working in the accounting field, or students who are just learning, starting to learn this, right? And for this series is for GCE O levels, so for those who are studying for the exams, right? All the best as well. And yeah, hopefully just make it easier to understand. So I tend to use more relatable examples, right? Not extremely to do with the business side because I understand that most of us, when we start learning accounting, we're students, right? Most of us don't have the real world knowledge uh, to really grasp the concept. So hopefully, I serve as a bridge, right? Albeit not the best bridge, but a bridge nonetheless, right? Hopefully, right? And yeah, that is the goal of the channel, at least the content. I do stream other forms of content as well, and they're recorded. If you know where to find them, yeah, it's in one playlist, right? If you want to enjoy watch, chaos or other interesting stuff, you can feel free to check them out. uh the link is on my YouTube profile somewhere. It's not a main thing, even though I do it more frequently. It's just there for me to really de-stress after a long day at work or something, right? So we still have a minute, right? So for those of you who are watching this, I hope that you take away something from it, right? Either accounting knowledge or certain explanation gels with you. Yeah, then that's good enough for me. Yeah, and like if you take away any form of um gain something from the stream or watching the VOD, right? I'm happy with for you. And other than that, yeah, if my explanation doesn't work for you, right? Firstly, it's perfectly fine. Okay. And secondly, just ask the question. Either during my next stream, right? Or drop a comment on YouTube. I'll try to revisit the content and really answer the question. Try a different explanation, see if that works for you, right? Other than that, yeah, it's really just a learning process for both of us, right? For me as well. Um, and without further ado, it is 12 p.m. UTC. Let's just start with the lesson proper. So let me bring up the where is it? Let me bring up the questions for today. So we are doing question 3, right? And let's just read the question first. So 3A, what is it asking us for, right? Calculate rate of inventory turnover for the year ended 30th September 2024 and show your answer. So what is inventory turnover? First of all, it is essentially the number of times your full inventory was sold. So your full inventory, as in your average inventory for the whole year, uh, was sold. So if you notice, okay, let me just try to write this out. Hang on. Okay. If you remember the double entry for making a sale, right, is your debit cost of sales or cost of goods sold, and you credit inventory, right? So, I mean the same amount, right? XX for whatever figure is just the same on both sides, right? That's how you record a sale on the inventory side and the expense side, right? Because you gotta have bought the inventory from somewhere, and that cost is directly related to, you know, you earning that revenue from that sale, right? So you gotta tie the expense to the revenue, and that is a concept called matching principle, right? So that is the double entry, right? Debit cost of sales, credit inventory. And you notice that for the formula, it's cost of sales divided by average inventory for the year, right? So what does this mean? Cost of sales at the end of the year means the amount of inventory sold throughout the whole year, right? Because the double entry says so. And average inventory just means the inventory at the end of the year plus the inventory at the start of the year divided by 2. So that is, let me just write it out. Cost of sales divided by beginning inventory plus ending inventory. I'm just going to use short form here because I don't want to take too much space. Divide by 2, right? And the whole purpose is to find out how many times you have sold your entire, you know, like quote unquote entire inventory in a year. So what does this mean? Essentially, if the number is too low, it could mean two things, right? Either your inventory is too much, so you're keeping too much inventory, leading to higher risk of obsolescence, of damage, Um, or if the number is too high, it means that um, no, sometimes you might not be keeping enough stock. Um, but most of the time, higher is better, right? Usually, you won't see obscenely high numbers. Because that is not practical. Not, I'll say it's not feasible in real life either. Because we gotta source our inventory from somewhere, right? And having small inventory and high turnover means that your inventory is coming in like every goodness knows how often, right? Like maybe every hour. Then you have very high turnover. But that will also mean other costs incurred, like delivery fee and all that stuff, which sometimes are not included under inventory, right? So this is why none of these, what we call ratios, accounting ratios, should be used in isolation, right? We should use it together to get a good picture of the business, and that's the point of it, right? So back to the question, right? What are they asking for? They're just asking you to apply the formula, right? So we just plug the numbers from the question, right? Cost of sales for the year was 287,700 divided by the ending inventory, the beginning inventory, which is 2023, right? 28,000 plus the ending inventory, 19,000 divided by 2. And well, you can type all of that into the calculator, which I'm gonna do right now. 287,700 divided by bracket 28,000 plus 19,000, whole thing divided by 2, 12.24. Yes, 12.24. Right, and that's rounded to 2 decimal points. Okay, so I hope that is the correct answer. I'm just gonna do a quick check. Should be fine. Yep, okay. Yeah, so 12.2, sorry. 12.24 times, right? And that is the answer for it, right? But the purpose is to actually explain to you what inventory turnover means and why it's important. Essentially, it just tells you how fast the company is selling their uh stock relative to the amount of stock they are keeping, right? So usually higher means better, right? Usually. And lower means worse because you are keeping too much inventory or you're just not having enough sales, right? All right, so next one. We look at this is okay, B. Comment on rate of inventory turnover for both businesses for both years and use the information provided. So this is more of an analysis question, right? Um and okay, let's extract some information, right? For Edison's business, 2023, it was 11.45. Now it is 12.24, right? And yeah, okay, it's Edison's business. Then we have a competitor called Trendywear, right? And in 2023, they had 10.35, and in 2024 they had 9.25. So what does this mean? When you're comparing ratios like these, it's best to not have a absolute comparison, but a percentage comparison, right? So we can have a matrix, a grid kind of. Not sure if I probably need more space on this. Okay, so Edison's business and 2023, 2024. Okay, in the exams, you probably have to write it out in, written form. So who is the competitor? Trendywear, TW. Okay. So in 2023, okay, we compare within the company first. So we compare within Edison first, right? So from 2023 to 2024, there was a increase, right? So let's just do a calculation. What was the increase? Like 12.24 minus off the previous year's one, 11.45 divided by the previous year's value, 11.45. So it's about a 6.9% increase, right? Across the year, right? And then for TW, it is 10.35 minus 9.25 divided by 10.35. Oh, sorry, 9.25. Okay, so it's a negative number, right? Because there was a decrease from the previous year. So 9.25 minus 10.35. So that's about a 10.6% decrease, negative 10.6. Right, into the next year. So what does this mean? When you're comparing within the company, right? So E improved their business, right? They managed to make more frequent sales. It doesn't necessarily mean absolute sales, but more frequent sales, right? Compared to TW. So there's a lower risk of inventory becoming obsolete, becoming damaged, to you losing value of, like you losing value for the inventory basically, right? However, for TW, it actually decreased from the previous year, right? So okay, let me just write down the formula. So you have the previous year sorry, not the previous year, the current year. Yeah. Okay, so we have the current year minus the previous year divided by the previous year times 100%. That is how we get all the percentage values. Okay. So yeah, that is year by year, but within the company, right? There is one more comparison that we can make. And same thing, we're just gonna draw the grid, right? 2023, 2024. E and TW, right? Next, we compare between the companies within the same year, right? So for let's just see how much E was, how much better E was doing than TW. How about that? So for 2023, E had 11.45 minus of 10.35 for TW, then divided by 10.35, the basis of comparison, right? So I mean technically we could do it the other way as well, like even 11.45 at the bottom. Okay, yeah. So this E is 9.6% more than TW in terms of inventory turnover, right? And in 2024, it is 12.45. So 12.4, sorry, is it 45? Let me double check. 12.24, sorry. 12.24 less 9.25 divided by 12.24. So yeah, E is 24.4% ahead of TW, right? So what does this mean? It means that the gap between these two companies are widening in terms of inventory turnover, right? And yeah. Okay, wait, maybe here is okay, it's a bit confusing if you're reading the notes as is, right? But hopefully you guys can see the difference, right? So this E is higher, right, than TW. Hopefully that gives a good hmm. Not sure if the interpretation will be missed here, but you know what? Let's just roll with this for now, right? Uh, yeah. So that will be my explanation for the answer, right? So I compare between the 2 years first, and but within the same company, and then we compare between companies in each of the 2 years, right? Um. Okay. So I hope that is B answered, right? Next is suggest one way in which businesses might improve their rates of turnover. Um, I mean, it could be accounting related. It could also just be dealing with the ratios. If we just look at the ratios, it's quite easy to see, right? If we want to increase, okay, so we look at this. Let me use a different color. Let me use red. If we look at this, you know, formula, right? You either to increase the inventory turnover, you either increase your cost of sales, right, or you decrease your average inventory. And to be honest, it's easier to decrease average inventory because it just means you keep lesser stock on you, right? But it comes with a specific drawback where you will have frequent stock out situations where people come to you to buy stuff, but you cannot sell to them because you're out of stock. And you lose sales, you lose trust, right? So that is the trade off for the easier method, right? So again, I'll write down the answer here, right? You either increase cost of sales. How do you do that? You promote sales. To increase cost of sales, you increase sales, right? The reason why you cannot just buy more expensive inventory is because your average inventory will be going up as well, right? So sure, for the first year it'll still work because your average inventory will be dragged down by the previous year's lower average, right? Lower amount, sorry, not lower average. But the next year, if you continue buying the same, more expensive inventory, it won't work, right? Because your average inventory is already pulled up, right? So the most straightforward way is just to increase your sales, just sell more, right? But that is difficult to do in real life, right? The other way would be to decrease your average inventory. Oh, okay. So yeah, to decrease your average inventory, can be done in a few ways. You can try to manipulate the numbers again by buying cheaper inventory, but again, your cost of sales will decrease because you're selling cheaper inventory, right? And your average inventory will also decrease over the years because, it's current year, and if you keep buying the cheap inventory, your average inventory will go down as well. So end up you probably don't have much of a change, right? Maybe only for 1 year. So it's not sustainable. So you keep lesser inventory in general, right? To decrease the risk of any inventory getting destroyed, becoming spoiled, becoming obsolete when no one wants to buy it, this sort of things. Right. So hopefully, yeah, I mean that's two answers, right? This is one, this is two. Okay. And right, let's go to this extract. Okay. So on 2025 year end, 30th September, they have ending inventory of 17,800. Okay. However, there is a fire and it was reduced to this amount. Okay, so here immediately you see the question, you know that there is something called impairment loss. Impairment loss on inventory, right? And if you just do a quick calculation, 17,800 minus 14,900, 2,900, right? So that is impairment loss on inventory, and it is under other expenses, right? So, okay, then we look at the question, right? D, they want you to prepare the extract, meaning you don't need to do the full thing, right? But you need to prepare financial performance, meaning profit or loss statement, right? Um, so we start off with a dollar sign on the right. On the right. Sometimes you can have two, right? So the purpose of it is like less other expenses, right? And then here you have oh, it's a little cramped. Hold on, let me see if I can do this. Impairment loss on inventory, right? I'm just going to use short form again, right? And then you write it on the left side as a positive number, so 2,900. However, at the end of it, when after you add up everything, it is a negative number, right? Because it's less a certain amount. You minus it off from your gross profit, which is your revenue less your cost of sales, right? Next, we need to prepare another extract of financial position, statement of financial position. That would be what we call the balance sheet, right? For this year, and yes, right. So, I mean, you could just write inventory. This would be a dollar sign again, and 14,900. For those of you who want to be more detailed, not sure if the exam requires this, right? But if you want to be more detailed, you can write inventory at cost, 17,800, less accumulated impairment loss on inventory, 2,900, and then you put a net value underneath it. That works as well. Yes. So, but I think this is fine. If I'm not wrong. Okay, let me check. I don't want to teach the wrong thing for exams here because this structure is important for this exam. So let me check the answer for this. Yep, okay. So yeah, this is accepted. This method is accepted, so you can just use this, right? Okay, next is name and explain accounting theory. When accounting for valuation of inventory. So first of all, we need to understand what the valuation of inventory is, right? And then what the examiner is looking for is accounting fundamentals, right? The guiding principles and the guiding theories, right? So valuation of inventory would be lower of two things. The first is the cost. What does that mean? The cost that you bought the inventory at, right? That is relatively straightforward. The next one is net realizable value. Okay. net realizable value could mean a few things. Essentially, just uh what uh what you can sell it at. Oh, okay. Yeah. What you can sell it at after a certain event. Usually it's an unfortunate event, right? For example, in this question, a fire destroyed some inventory, right? It can be damaged, right? And you gotta pay money to fix it. So sometimes you can call it selling price after the event, less of repair cost if it's damaged, right? If it's beyond repair, then you just take the full amount, just put it at zero, right? It hurts, but unfortunately that is the truth, right? You can't sell it anymore. So you just write it off as zero. So, what is the question trying to ask? It's trying to ask you, what is the guiding principle or guiding theory of this thing? Why do you take the lower of cost or net realizable value? The answer is prudence, right? Uh, and then explain how it's applied, which is basically this lower of yada yada. Okay. Prudence itself means that you be on the more cautious side when doing accounting. So basically, if you foresee a loss happening, right, you recognize the loss immediately. Whereas if you foresee a sale or foresee a gain, usually you don't recognize it immediately, right? You only realize it. You only recognize it when either it's realized or is virtually guaranteed, basically, right? So that there is a slight imbalance when doing accounting and treating these two classes, right? Either a loss or a gain, right? Usually we view loss more heavily, because if we don't do that, people can just take advantage of the system and just overinflate their gains, right? So this is more of like a check on on the way we do accounting. It is not foolproof again, but it prevents more issues, right? The only downside for prudence is sometimes you tend to understate your profits because you recognize the loss immediately, right? Even if it didn't happen. So your profits sometimes is lower than what it should be. And because we can't predict the future, right? You know, uh if that loss didn't happen, then you gotta reverse it in the next year, leading to an increase in profits for that year instead of the previous year, right? So it's slightly, not as accurate. So it impacts the accuracy of your reporting, right? But I think the standard setters believe that this trade off is worth it because you prevent the floodgates of people just, um, you know, reporting their profits as anything, right? Because they believe that they can earn 1 million in 2 months or something like that. Then they just write it as such. And that doesn't make sense, right? Like, sure, it could be a 1% chance or 0.1% chance, and they just recognize it as such. And yeah, it will cause a lot of chaos in the accounting world. So that's why I think the standard setters don't want that to happen, right? And so they choose to do this instead. They choose to force us to take a more cautious view, right? Force us to actually understate the profits when necessary, right? All right. Other than that, that is actually the end of the lesson. Pretty short. Um, Again, let me just do a recap, right? So, what did we learn today? Well, first we learned what is inventory turnover, right? We learned exactly the formula. We learned why we use it, right? So inventory turnover, it really just tells you over the year how much of your average inventory have you sold, right? How many times have your inventory left your warehouse, quote unquote, and get restored, right? Of course, it's a flowing process. You don't sell out your entire warehouse and restock, right? That's not how it works, but we are assuming that's the case, right? So yeah, that is inventory turnover. Why it's useful? It tells you um two things actually: how fast you're selling your inventory, right? And how efficient your inventory management is, right? And generally, this number higher better, but if it's too high, it could suggest other problems, right? Um, Next, we did a bit of analysis, right? This is new. So when you're comparing two companies and 2 years, uh, there are really only two ways of doing it. First, you log in the company. So, for example, you analyze the company's performance between 2 years, right? Then you switch to the next company and you analyze between the 2 years. The other way of doing it is you log the year, right? In the same year, how did these two companies fare against each other, right? It's not really feasible to compare together per se. Like if you're having too many variables, it's a bit too difficult to do comparison, right? Um, so yeah, and question C, one way to improve their rate of inventory turnover. The exam trick here is if you know the formula, you can decipher it from the formula. So for example, if you know the formula as you know, cost of sales over like divided by the average inventory, you can just see which one you want to change, right? If you want the number to increase, then you either increase the numerator or decrease the denominator. This is math. Yeah, this is a little bit of math. So you just gotta logic your way through this, right? And then the next one, they tell you some information. You can just do a quick calculation on impairment loss or inventory. Most of the time, they give you this information for a reason, right? Most of the time, but it's always best to look at the question first, right? So you look at the question, and yeah, they want you to give an extract of the income statement or statement of financial performance or statement of profit or loss. It's gone through too many name changes. I can't. All right, and then the next one is financial position or balance sheet. As far as I know, these are the two main names for them. And yeah, this is the reporting uh framework that they want you to go with, right? In the actual answer, I believe this 2,900 is just on the rightmost column. For me personally, I like to write two columns just to do a calculation and then a sum on the other side, right? And lastly, we gotta do a theory question as usual. So prudence, and then explanation according to answer is just the definition of valuation. Like how do you value inventory? That's it. So yeah, hopefully you guys learned something from watching either the stream or the VOD, right? If you're watching the stream, thank you very much. If you're watching the VOD, also thank you very much. And hopefully if you like what you see here, you can, you know, uh choose to come back for more, right? Or you can watch the YouTube videos if you don't understand it the first time, right? Again, if you don't understand a certain, concept, please ask in the chat, right? There is no judgment here. There's no question that is really too dumb, I would say. Everyone gotta start somewhere, and I think my role isn't exactly to give you the model answer. Isn't Yeah. And most of the time is to give you a correct answer, hopefully. Right. Hopefully I don't make any egregious errors here and there. uh but yeah, it's really to guide you through how you can tackle a certain question or tackle a certain situation, right? Really flesh out the thought process of you know how I think when I look at a certain question, right? The things that I take note of. So in the exam or in real life, you can actually zoom in on the details faster, right? Other than that, yeah, this is really the end of the stream. It's a very short one today. And I'll probably stay for maybe a few minutes to see if there are any questions in the chat. Other than that, I'll keep yapping. Don't worry, I'm paying attention to the chat. I can see. I don't know if questions, right? Um, but yeah, uh, there should be a stream after this, but it's not educational, right? It's more of my relaxation period. Uh, Playing games with friends, enjoying my hobbies, things like that. Um, so yeah, other than that, I will be uploading the VOD onto my YouTube channel. Um, I think by tonight, right? And I'll upload the notes as well along with the video. Unfortunately, you guys can't. The notes are pretty messy. I'm not going to lie. So you probably have to refer to it while watching the video, right? It's never meant to be a cheat sheet per se. And also, I would like to reiterate, if you don't have the practice questions and you're taking GC O levels, please go and buy it and please practice it on your own, because accounting is a very practical subject, right? You can really only get better at it by doing the doing questions or practicing it on your own, right? Example would be if you're just out working, right? Or walking along the street, whatnot. It might sound a bit troublesome, maybe a bit unhinged. You look at certain event happening and you try to think of it in accounting terms. For example, um, you see a busker on the street, right? And someone gave them money, right, for their work. So you can think of it from the busker's perspective, right? To them, they earn that amount as revenue, right? And what is their cost? Well, their cost could be their meals, right? If they hadn't had to busk outside, they might not have to, you know, uh, eat a more expensive meal, maybe, right? Um, Other expenses could just be their living expenses, their instruments, right? Their instrument is their asset, and it'll depreciate over time, and once it's fully used, or it breaks, they gotta buy a new one. Yeah, this sort of things, right? You can think of it as a whole story, um, and you can write it out in accounting terms, right? That is how you can practice. But of course, it takes a lot of time and a lot of mental energy. So if you're not up for it, it's perfectly fine. Just do the practice questions, right? Uh, I'm one of those who like accounting, but I don't like the exams. So you can probably see it, right? I can't memorize my theory questions. I'm probably gonna get a few things wrong while explaining this, but mm, at least to me, if my thinking and logic is sound and I can back it up with evidence, I would stand by it, right? Until I'm proven wrong. Probably most of the time, right? But yeah, okay, that's been a few minutes. I've yapped for long enough. I don't see any questions in chat, so yeah. Other than that, hope you enjoy your weekend or your break. If you're watching this, thank you very much for making it to the end of the stream, to the end of the VOD. Um, I'll see you guys next time, right? Take care, yeah? Bye bye.